Hello and welcome to Market Domination. It is Tuesday, May 27th. I'm Josh Lipton, live from our NYC headquarters. Here's your headline Blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Nice to see a little bit of a rebound. We've seen significant weakness in a lot of the survey data, in the soft data, as you point to, and it suggests that consumers are at least somewhat sensitive to the news flow, the back and forth on tariffs. We got the back, if you will, and now with the forth, consumers seem to be feeling a little bit better about things.
We think don't overlook mid-caps. People worry about concentration in the Mag 7. Okay, well, maybe I'll equal weight the S&P or something. Well, why not just go to mid-caps? They're the number one slice of the equity markets for 4 decades in a row, and they're dividend growers there. Our ETF, REGL, the S&P 400 Dividend Aristocrats. So those are some of the ideas that we have in terms of thinking about that rising rate environment.
We are ramping a new architecture called Blackwell GB200 and NVL72. Obviously there's some supply constraints related to the ramp, but it's a hardware plus GPU chip-based solution that also integrates the GPU into the CPU, which gives them a significant performance advantage over the competition. The competition does have a roadmap that is expected to follow suit, but they're at least a year behind at this point.
All right, we've got 1 hour to go until the market close. We're taking a look at the major indices right now as markets eyeing a big comeback. So listen, we had the consumer confidence report. That was a rebound. That helped. We had the US-EU tariff reprieve. We had Japanese government bonds, a bounce there in the JGBs. Added up, you can see right there, green everywhere. I got the Dow up more than 700 points. The S&P 500, your broad gauge, it's popping about 1.9%. And your tech-heavy NASDAQ, that's tacking on it 2.3% here. Let's kick over to Yahoo Finance's Jared Blickery for more on today's moves. Jared.
Thank you, Josh. We are in the midst of a nice rally here. Best day for many of these markets, especially the major indices, since May 12th, so over 2 weeks. And let's take a look at the Wi-Fi interaction behind me. You can see the Dow is up over 700 points. That's good for 1 3/4%. We started the day up, gapping up, and it has been up and away ever since. And we are really close to those highs of the day here. Let me just show you the last 5 days, because last week the Dow and the S&P 500 were down 4 days in a row, Tuesday through Friday. And here's the S&P 500. I'm going to draw in here the 200-day moving average, just barely kissed that and bounced off. And so major technical support has held in the S&P 500. That is driving the bus. And the bulls are in control still, notwithstanding last week's slight misstep. And if you're looking for an outperformer here, here's the Russell 2000. I'm going to draw this back to an intraday chart, and you can see we are up and away here, up about 2 1/3%. And we got to check out the VIX, because that has dropped back below 20. Only last week it had surged to 25. That was very brief, however, and we are back below this key psychological level. And we got to take a look at the bond market, because in the background of all this, last week some of the problems were associated with things in the bond market. The 30-year in particular had surged north of 5%. Well, guess what? Today it is down about 9 basis points. That's a lot for the bond market for the 30-year, and it is now at 4.94%. So 6 basis points under that critical threshold. And guess what? The world likes dollars, so the US dollar index is up as well. Now let's get into some heat maps and look at what is outperforming today, and everything green. All 11 sectors in the S&P 500 are in the green. Leading the way is consumer discretionary. Tesla is a leader there. We'll take a look at that in a minute. Second place, up 2.3%, is the tech space. And in final place is staples and utilities, but even those are up almost 1%, those defensive sectors. So here's what the way the NASDAQ 100 is shaping up, and you can see a lot of those Mag 7 names to the left. And here's Tesla up 5.7%. Here's the year to date, and you can see it is just breaking above this resistance level that is held for a couple weeks now. So that's a big technical development for the bulls there. We can also see Nvidia, everybody looking forward to those earnings next week. Nvidia up 2/3%. And guess what? Nvidia is now positive on the year once again. Back to you guys.
Thank you, Jared. Joining me here now for today's program is Barron's very own associate editor. That would be Al Root, who is here on set. Al, always good to see you, my friend.
Great to see you, Josh.
So let me get as a long-time watcher of the markets, a student of the markets, Al. Let me get your take on these markets. Are you impressed and surprised by how resilient they have been despite headlines, reports, Trump, tariffs, trade, all the drama? What do you make of it?
I'm actually a little nervous, right? We had a Liberation Day, and the market sold off. We're up basically 16% from the April lows. We still have tariffs. We sort of have unbelievable uncertainty, right? That April consumer confidence report is like 86. Today was 98. So consumers are all over the place. Policy is all over the place. We have deficits exploding potentially with tax bills. And amidst all that, we have sort of like a FOMO rally. So I got to tell you, I'm a little nervous. Stocks go up over the long run. We all know that. But I got to tell you, I am surprised with the strength of the rally.
By the resilience. Let me get you this. Tomorrow, of course, all eyes on deck. Maybe the most important data point of the week, Nvidia earnings. Your expectations there. How important is that report, not just for Nvidia, which is a well-known, well-owned name, but for the broader market?
Yeah, you probably can't overstate the importance of Nvidia's earnings because the AI trade, aside from policy and all the things we just talked about, the AI trade is driving everything. Jensen drives that. Nvidia drives that. Interestingly, the growth, we expect 65% sales growth, but only 25% earnings growth, some of that Blackwell changeover and supply constraints. So, they're going to be trying to thread the needle, right? They're going to have to give good guidance. They're going to have to, paint a picture that demand is still growing as far as the eye can see. Interestingly, over the last couple of prints, there have been, consistent beats with good guides, but the stock has sold off a little bit. We've sort of, just unbelievable growth, AI is here story has sort of faded. So it's a little tougher, but it's the event of the week.
It's the event, and you know what, Al? I have just the man to talk more about it with us. Because for more on NVIDIA's upcoming earnings report, let's welcome in Yahoo Finance's Dan Howley. Dan, what are we watching?
Yeah, Josh, let's just go over the numbers that we're expecting real quick. First, we're expecting to see earnings per share of 88 cents on revenue of $43.4 billion, and that would be up from 61 cents in revenue of $26 billion in the same period last year. We're also looking for data center revenue of $39.2 billion, and that would be up from the $22.5 billion. And then gaming revenue, this was originally a gaming company. Still its second largest segment, but way smaller than the data center. That's expected to come in at $2.8 billion, up from $2.6 billion. All of those numbers are important. I think the big one, obviously the big one is data center, but the other one that people are going to be looking at is China revenue and what that looks like after the Trump administration banned the sale of NVIDIA's H20 chips there. The company announced that they are taking that $5.5 billion charge. The revenue for the region for the quarter was expected to come in at $6.2 billion. That would have been a 150% increase from the $2.4 billion they had previously seen. And I just want to go over something that we had seen this morning from Joseph Moore at Morgan Stanley, basically saying that, look, this is something, there's no way to offset that kind of loss. Like, there's no other place for NVIDIA to really kind of come back from that for this quarter, specifically because they can't sell Blackwell chips into China at all. These chips, the H20s, were originally built as a way for them to continue to sell devices into China after the Biden administration had said you can't sell your highest end chips. Back then it was the Hopper chips. So the H20 is based on the Hopper technology. Now those are banned. This all kind of comes as a result of the growing fears of China and its AI capabilities. DeepSeek didn't really help with that because the company proved that they could put out high-end models without using top-of-the-line chips like Hopper or Blackwell itself. So the Trump administration kind of said, look, we're just going to put the kibosh on that, even though there was some inkling that they may have gotten the ability to continue to sell them. Jensen Huang had been going back and forth to meet with Trump. But obviously that's going to be, I think, the main thing that people look for is what's happening with China, what are their plans going forward. There's been reports from Reuters that they're working on a modified version of the H20.
Like a China compliant.
Exactly,
right,
yeah. Exactly what they did with the H20 to begin with, right? Making a chip specifically for the Chinese market. Huawei is gaining steam there. right? Jensen Huang's argument is if Nvidia is not sold in China, then you're creating this kind of separate ecosystem, right? We've talked about the two webs, right? The internet in China and then the internet in the rest of the world. Well, there's the idea then of the kind of two graphics card or AI accelerator chip markets. One would be China, one would be Nvidia and its competitors in the rest of the world. And so what does that mean? Do you want then China to be reliant on a US technology? Jensen Huang says that's the ideal, but obviously the administration saying we just don't want them to have chips, period. So, I mean, it's going to be very interesting. Usually after these reports, the stock kind of wavers a little bit because I think for the past few quarters, people have been like, where's that 400%? What's 100%? That's nothing.
Yeah.
Where's that 400% growth? So I think we might also continue to see that as well.
Do analysts who cover the stock, do they think all the new kind of business that Jensen is able to drum up in the Middle East, Saudi Arabia and the UAE, how much that can potentially offset pressure in China?
Well, yeah, I mean, I think that's something that obviously it's a reprieve for them because there's now these Stacey Ragson had said, Bernstein analyst, had said that it's a way to show that there's still deep-pocketed customers out there that want access to this. And so now they have access to this. I think there was a couple of 100,000 chips that they talked about going even further beyond that, right? So there's a desire for these chips, and NVIDIA is going to be able to now sell them to those countries. And so the other thing is the AI diffusion rule was knocked down by the Trump administration. That was put in place by the Biden administration at the end of kind of a last-minute move by the Biden administration. And that would have set up a three-tier system of who meaning countries, can get access to high-end AI chips. So that there was the top that could just get free access to it, a second layer that they would need specific licenses, and then a third layer where countries that already have arms embargoes on them. That's gone now. The Trump administration is working on some new rules. We don't really know, but that was also good news for them in the quarter.
What do you think? So lots going on. What are your sort of number one and number two issues? Just you get the print, the conference call starts. What do you want to see? What do you want to hear tomorrow?
I want to know exactly how high data center has gone. I think that's going to be the big thing. And then if we get any kind of commentary as to what they're going to do in China, that'll be the big thing, I think, if they can mention that at all, right? The Reuters report said that they're working on something, but if we get something on the earnings call itself and Jensen says, yeah, we're working on something, then obviously everybody will be a lot more excited that they're able to sell into the Chinese market. But even if they make that, there's no guarantee that that also won't eventually be cut off.
All right, busy day for Dan tomorrow.
Yeah.
Thank you, Dan. Appreciate it. Stocks eyeing a comeback from Friday's losses with yield sliding as Japan looks to restore comp to its bond market. For more on the latest market signals, let's get to Granite Shares founder and CEO Will Ryan joining us now to discuss. Will, great to see you on set.
Good to see you too. Thank you.
So, listen, we had green across the screen today. Will, consumer confidence, a rebound there, a bounce in JGBs. Walk us through what you made of today's market action.
I think that all of the above, like you said, plus another tweet, another reprieve for a potential trade battle, this time with Europe, I think just gives people some confidence that perhaps we're moving in the right direction finally. Europe, obviously a massive trading partner for the US, so some more certainty there, I think calms the nerves somewhat, and then coupled with these more positive surprises that we saw, namely consumer confidence, and then the news out of Japan, just helps lift things today.
Do you think, I opened the show, I'm sort of a little surprised that we have just this push and pull of policy. The EU was founded to shaft the US. Oh no, we're going to pause tariffs and negotiate. Am I wrong to be that worried? Do you think that we have the playbook from this administration, that it all is going to sort of go okay?
That might be, the playbook might be maybe a bit of a stretch, but I think there was a comment I saw on Friday, after the tweet came out, and I think everyone was feeling a lot better about the trade pathway more broadly, in the last couple of weeks until the end of last week, where we got that tweet about Europe. And there was a comment that was made where it was, to sort of paraphrase from Europe, it's just another tweet, sort of roll the eyes type thing. It will be reversed, or it will be, and the markets in Europe didn't really respond on the back of it. And I think that's kind of where we are as investors, that it's, on the one hand, it's disappointing to see, but on the other hand, I think the more that this happens, the more markets will kind of discount the impact. And then as soon as you go the other way, it's sort of off the races.
It's interesting, Will, you bring that up, because the economist Stephen Stanley was writing his clients today about the Trump tariffs, and he said, this is how he put it. I'm interested to get your take on this. He said, the book is far from closed on tariffs, but financial markets seem ready to move past it. And these numbers, and he was referring to the consumer confidence report, suggest that households may be moving in that direction as well. What do you think? Maybe this feeling of moving past it?
I think that's very much where we were up until the end of last week. And I think that is probably partly reflected in the consumer confidence numbers that you see from May. I think people were ready, clearly, for us to get more positive on things. And I think the administration, I don't speak for the administration, but I would sure they want to move past this as well and get on to more pro-growth, to deregulation, other things in their agenda. Because the tariff thing, let's be honest, has been very negative.
Well, I'm coming across as wholly too negative these days, but once we get past trade and we get deals and we start thinking about taxes, we'll start to think about the deficits, we'll start to think about bond yields. Should we start to worry about that? Should we just pay attention to stable bond yields? What's next after we get through some of this trade volatility?
I think the deregulation thing, we've yet to really see what the administration's plans are for deregulation. Certainly, we've seen the tax proposal come through, and the markets, the bond market, let's just say, initial negative reaction to that. I think, as the Treasury Secretary's talked about a number of times, and the goal is to reduce yields, particularly on the longer end of the curve. That looks better today than it did at the end of last week, but clearly you need stability. I mean, look what's happening in Japan with their government bonds, particularly at the long end. Insurance companies in Japan, other investors holding the long-dated bonds, have suffered massive losses, and now the government are going to have to act on that, which they are starting to do.
Well, I asked Al for his take on this, but I want your take too. Nvidia earnings on deck tomorrow. How important is that report for the mega AI trend and theme in the broader market?
I think, as you've already heard from Dan, I think it's massively important. This is the most important company in the world right now when it comes to AI, the most important theme in the investment world right now. So it's all going to be about Nvidia earnings tomorrow, and the guidance. My just initial 2 cents on top of what's already been said is, I think, to the extent we get it tomorrow, which I don't think we will, but if we get any kind of kernel of insight into the administration's thinking around China and the rules of the game vis-a-vis the US and China and the battle for AI, I think that's really what a lot of investors are looking for the glide path for Nvidia ultimately going forward.
All right. Thank you, Will, and stick around. We'll be hearing more from you later. We are just getting started here on Market Domination, but coming up, investors, they've enjoyed Nvidia's meteoric rise. That stock up a whopping 40% over the past year, and we're taking a by-the-numbers look on Nvidia's impressive track record when we return. That story and much more coming up.
This is Yahoo Finance. I'm executive editor Brian Sozzi and also the host of the Opening Bid podcast. Arguably the most important Magnificent Seven member, you guessed it, folks. Nvidia reports earnings this week, and the usual hype is very hard to miss. Stock is up a sizzling 40% over the past year, but down this year due to concerns on AI demand and China chip export controls. But analysts are staying overwhelmingly bullish on one of their favorite stocks. 87% have a buy rating according to analyst recommendation data found on Yahoo Finance, and the average price target is around $162, implying major 25% upside from current price levels. But with the stock trading at a pricey 31 times forward earnings and up more than 700% over the past 3 years, pros I chat up on Wall Street are beginning to ask a key question. How much of NVIDIA's AI dominance is already priced in? So let's quickly look at NVIDIA's headwinds, which the bulls often seem to forget about. We'll start with geopolitics. U.S. export restrictions have cut NVIDIA's China market share in half. NVIDIA founder and CEO Jensen Huang says the company has already walked away from $15 billion in China sales and written off a staggering $5.5 billion in inventory tied to its banned H20 AI chips. Plus, the competitive landscape is shifting. Cloud giants like Amazon, Microsoft, and Google, NVIDIA's top customers, are racing to build their own AI chips. And Chinese firms like Huawei are also quickly closing the gap. There are also upstarts like Grok that have raised large slugs of money to take on Nvidia in all things AI chips. Meanwhile, investors are more closely scrutinizing Nvidia's profit margins. Despite continued robust demand for Nvidia's Blackwell AI chips, the company's gross profit margins are compressing, pressured by rising data center costs and complex new hardware. Some investors are hedging, including Michael Burry of The Big Short fame. He recently bought put options on Nvidia, betting that chipmakers' rally is running out of bandwidth. AI might be the future, but Nvidia's valuation may already be there. This week, we'll find out if their results were worth the usual hype.
A potential U.S. steel deal has been a long time in the making, and we saw a surge of over 20% in U.S. steel stock, reflecting optimism as the deal with Nippon Steel progresses. Late last week, President Trump made news by reviving the deal and endorsing a partnership with Japan's Nippon Steel. Under that plan, it would remain headquartered in Pittsburgh, Pennsylvania, with an American CEO and a board with a U.S. majority overseeing operations. Now, Nippon would invest $14 billion, including building a new U.S. steel mill and upgrading existing plants. The agreement would address national security concerns while allowing foreign investment. Our next guest has been following this all very closely. He's Axios' business editor, Dan Primack. Dan, it is always good to see you. So you argue in your piece, Dan, you say, listen, this actually is all entering, I think, Dan, you called it the ludicrous stage. Correct me if I'm wrong. What did you mean by that, Dan?
I mean, for starters, we get an announcement from Trump and sort of from U.S. Steel last Friday saying there was a, quote, partnership. They make no mention of the acquisition of the $55 per share that U.S. Steel shareholders are supposedly getting, but maybe not because we haven't called it an acquisition. And then today, Tuesday, when the markets reopen, U.S. Steel shares continue to trade on the New York Stock Exchange, which decides not to halt it or even explain why they haven't halted it. So everybody thinks there's a deal, but isn't 100% sure. And we haven't seen any of the real details. You know, you talk about that $14 billion that Nippon has promised. Maybe. Is it guaranteed? If so, how? The earlier pledges were just that. They were pledges. But Nippon could have bailed on those if it wanted to for no particular reason. So really, this is the strangest thing. We have a massive, massive acquisition, a $15 billion acquisition that no one's acknowledging right now as an acquisition. And U.S. Steel isn't saying it, basically because they don't want to step on Trump's toes because he's got this big in-person press conference on Friday.
Yeah, don't you feel to some extent, Dan, like this is a bit of face saving though? And you can almost look at the outcome in the market to say, oh, okay, so we're calling it a partnership, but effectively the deal is going to close as originally envisioned all the way back in like December 2023. And then so we're just sort of working out politics. So President Trump can say 70,000 jobs, 14 billion, you know, headquarters in Pittsburgh. So look at that. Well, essentially, I just let the deal close. It feels like that's what the market's saying.
Basically, yes, although that's embarrassing for U.S. Steel, or U.S. Steel should be embarrassed that it feels it has to kowtow in that sense. And as for the Pittsburgh thing, that was a big announcement, part of the announcement Friday, right? The headquarters will remain in Pittsburgh. The headquarters was always going to remain in Pittsburgh. That was part of the deal. The only reason it was going to move from Pittsburgh, or that U.S. Steel even threatened that, was if the deal did not close. So that was never a source of negotiation in the first place.
Dan, I did hear Senator Dave McCormick give an interview this morning, and he talked about how there's going to be a U.S. CEO. He said there's going to be a U.S. majority board. U.S. is going to have golden share in Nippon Steel's takeover of U.S. Steel. Do we know? Is this what Nippon has signed off on all this already, Dan?
We don't know because they haven't said anything either. So we're not exactly sure. And then let's assume that what McCormick said is true and that all comes to pass. It's still unclear why any of that necessarily matters. Now, to some extent, would you obviously rather have local ownership or not local ownership, local management of U.S. Steel? Sure. It's closer to the workers. It's closer to the product. It's closer to the customer. Should be more responsive. However, go back to that $14 billion in promised investment. Just because you have a U.S. CEO and a U.S. board of the subsidiary, they can't pull. It's not like they have access to the bank accounts. They can't pull that money if it's not forthcoming. That money's still coming from Japan or not coming from Japan. That golden share isn't really necessarily worth anything when it comes to that money coming in or future plans.
So do you think this story is this incredibly long and very odd story coming to an end finally? Like, what are you going to watch for? Or do you think we have a few more twists and turns? Because, you know, early with the Prime Minister of Japan, Trump said, you know, it's going to be an investment. the companies didn't know anything about it. They never commented on that comment, and it just sort of went off into the ether. Are we finally into the end game, or do we wait for a couple more things?
I think with all things Trump and every sort of deal he negotiates or doesn't negotiate, you kind of do have to wait till it ends. I will tell you that as of this morning, the Steelworkers Union really was completely still in the dark. All they knew were the public statements. They hadn't had any back channel communications over the weekend. So I think we still have to wait. I will say the bigger picture thing here outside of U.S. Steel is what this means for future deal making, cross-border deal making, particularly for deals that might have national security implications. Because one of the takeaways I would think, if I was a foreign acquirer of a U.S. company, is I would look at this and go, okay, if there are national security concerns, the way we leapfrog those is to buy our way out of it, promise lots of investment, and then those national security concerns maybe will get put aside.
Dan, switching gears, last question. I want to ask you only because I know you write about and report about the IPO market a lot. So I have the chance to ask you. I'm going to take it, Dan, and your sources are great. The IPO market, just explain to me, Dan, where we are now, but also where do you think we are in the second half? How strong do you think that IPO market is going to be, Dan? And what are the variables that would depend on?
For starters, I think we are seeing, legit green shoots of a comeback, right? Because not only are you seeing some fintech, it was kind of a bunch of fintech names, and then everything went on hold after Liberation Day, and things are coming back. Circle launched its roadshow today. You've got Hinge and Omada Health, so a couple digital health companies out there, one that's priced, one that's coming. So I think there's some green shoots. I think what's tricky is the calendar, that this is all happening now. I think if Liberation Day hadn't occurred and this stuff had all started 1 month earlier, you might see a bunch more filings right now. Summer is always kind of a dead time for IPOs. People come back post Labor Day. Look, there should be a very vibrant IPO market in the second half of this year, outside of some sort of macro collapse, because you have a massive pipeline of companies. You have investors in venture capital funds and private equity funds that have been screaming for distributions for years now. And the market is strong. The fundamentals are strong. There should have been a strong IPO market last year and the year before. Finally, though, if we get a handful that have gone out and continue to price well in the aftermarket, or price well and then trade well in the aftermarket, there shouldn't be anything holding it back. But the only reason I've got any hesitancy in that is there shouldn't have been anything holding it back last year either.
Dan, always good to see you. We are always lucky to have you on the show. Thank you, sir.
Thanks for having me.
The Tesla shares riding higher. It's after CEO Elon Musk pledges his own return to office. Move coming as the EV maker faces weakening sales. Here with more is Yahoo Finance's Praz Tumarini. Now, Praz, you wrote about this today. Got new data. European registrations nearly halved in April for Tesla. What exactly explains that? I'm guessing, is it branding and politics? Is it Model Y update? Is it folks waiting for the new affordable model? What's going on there?
It's the good old story where you get the one headline, you get the stock moving the other way, right? We were talking about this earlier, right? So, but yeah, European sales, no surprise here, they're bad. Registrations down nearly 50% in April. Meanwhile, total EV registrations are up 34% in the month. So it kind of shows you where the money is going, where the buyers are going. It's a branding thing. It's a Model Y thing. The changeover happened. It's Model Y. New Model Y is trickling in those into Europe. It is there. The question is, why aren't they getting scooped up? That's one of the issues. But more importantly is, we're calling it Musk's RTO, right? He pledged again over the weekend in a tweet, kind of addressing an X.com outage, back to spending 24/7 at work and sleeping in the conference rooms, etc. Must be super focused on XAI and Tesla plus Starship, etc. All these things that are happening right now for Elon, and he says he's back.
Yeah, we talked about this. We both cover the stock. And how, I forget all this. I want to know how surprised you are that we're up like 50% since earnings, right? Earnings relatively weak, estimates coming down, no problem, stock up 50. It's a classic Tesla move. Just how surprised are you just the last 6-7 weeks of trading in this thing? It seems like it's just indefatigable.
Yeah, is retail so hyped on self-driving and Optimus and things like these way out there, pie in the sky type endeavors that Musk is doing, that Musk is spearheading at Tesla? Obviously, robotaxi, big month ahead next month with Austin unsupervised testing happening. Teleoperators, right? That's a big bet, right?
And the teleoperators, people just like, oh, no problem. This is okay. It's almost nothing. It's indestructible, right? You could say, well, actually, I'm going to be sitting in every one of the cars and I'm going to be driving people around. It feels like the stock would still go up.
Yeah, I mean, it's like the reality distortion field of Musk. It went from Jobs to Musk. People were just buying into it. And then the whole, like, I'm back. You know, is he going to be bringing the focus back to Tesla? You know, some managers there might not want his kind of eyes on everything, but it seems to be the stock, the investors like it. I mean, Gary Black was talking about today, actually, or yesterday, talking about how Musk's return actually isn't that big of a deal because the real problem is demand issues, like you mentioned, Josh, talking about the upcoming cheaper EV will likely be a decontented Model 3 or Model Y, not a brand new car, and that's a problem for their sort of growth plan.
And yet some of the bulls, though, Pras, are excited about that affordable model. I read notes today where they're like, it's on the way, it's going to hit in Q3, and that's going to be a growth catalyst.
I mean, the debate is it going to be sort of a version of the Cybercab, like that, a new sort of design factor, stripped down maybe two-seater, who knows, or is it going to be just the Model Y with less stuff in it? And I think that's, when we finally get that reveal, which has been talked about for over a year now, that's going to be the true reaction to the stock, is how excited are you going to be about that model, that form factor? Is it just for China? Is it for us? That'll
and then it gets right down to this idea of, do cars matter anymore? Right? Tesla has sort of morphed into this AI play. You know, we bandy about this idea of, when is it going to sell 2 million cars, right? Going to sell 2 million cars in 2024? No, not quite. Going to sell 2 million cars in 2025? No, not quite. Not necessary. We don't know if it's going to be a TAM expanding car that's coming, and yet the stock is still doing great, up amazing over the last 12 months, still down year to date. Do cars even matter anymore? Should we just pay attention only to the AI?
Right, and then Musk has been sort of changing that story as well, kind of over the last few months, the year during his conference calls, talking about how we're an AI play, we're a robotaxi play, don't own the stock if you don't believe in that. And that sort of says what you're saying is 2 million cars don't matter. It's what we got on the road right now, and the future cybercabs potentially that are coming out that are the ones that really matter for the trillion-dollar market cap or multi-trillion-dollar market cap of Tesla depends on software endeavors, AI, Dojo, all that stuff, right? That's the big bet. And I think, we just had earnings, a month ago, weren't good, and here we are, stock, 13% below flatline. I mean, it's just sort of almost all the way back.
That self-driving robo-taxis that Musk says, hey, it's coming next month, Texas. When you think about his potential competitive advantages in that space with Waymo, which is obviously way ahead, what are they, Al? How do you think about it?
Listen, so, we don't, let's listen to Jensen. Jensen says, Google and Tesla are the leaders in self-driving cars. Okay, that's fine. And if it works, there are substantial advantages. I drive a Tesla. There are millions on the road. Theoretically, the capital cost of building a fleet of robo-taxis is zero. I just put my car into the app and it makes me some money. And there are millions of robo-taxis where Waymo has thousands of robo-taxis. So on paper, it all works. The issue is they haven't actually done a fully autonomous paid cab ride yet. I'm not saying they can't. That comment will generate lots of emails, as I'm sure you're aware. But so on paper, I got it. Absolutely, I see the vision. I also want a robot butler. That's great. The question is, it's not here yet.
Yeah, on paper it makes sense.
Sure.
Yeah, Pras, thank you. Great to have you on set. Coming up, it is the latest edition of our series, Goodbye or Goodbye. We are taking a deep dive into 2 stocks to help you make the best moves to your portfolio. Stick around, much more market domination still to come. Well, it is a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal here, to help cut through that noise to navigate the best moves for your portfolio. Today, we are looking under the hood of the EV market amid tariff tensions. I'm here now with Granite Shares founder and CEO. That would be Will Ryan. Will, great to see you as always.
Good to see you too, Josh.
So let's start with what you like, Will. And your first take here, your buy would be Rivian. And we're going to go through the reasons why. Check out that 1-year performance. Look at that chart. First reason, Will, and walk us through these bullets. Candidate for alternative to Tesla trade. Walk us through that.
So this one has kind of 2 meanings. That on the one hand, I think there's still a huge amount of enthusiasm for EV stocks more broadly. But Tesla, perhaps quite rightly, steals all the oxygen from the conversation. So this is one about something that's an alternative, an EV company that's an alternative to Tesla, but it's also partly the brand issues that Tesla has suffered and people looking for an alternative investment if Tesla no longer fits their investment profile.
All right, bullet point number 2. This one, made in America, no tariffs, Will.
So it'll be quite self-explanatory, but this really sort of fits the zeitgeist at the moment, meaning a company that is sitting right in the good side or on the good side of the trade war. Vehicles are made here in America.
President Trump, it
exactly.
never hurts. Yep.
It's EVs, no tariffs or minimal tariffs versus other companies.
All right, and the third one, Will, here's another reason you say stick with a buy on this one. Existing models well received and new models are on the way.
So the existing models have been very well received. You know, the company makes high-end SUVs and pickup trucks, really kind of a status symbol in many ways. And so like companies like a Jaguar Land Rover with the Range Rover, they've been successful in building models that are perhaps less expensive, accessing a new type of customer. So Rivian here with its new models along the way, lower cost models, accessing both a new customer and diversifying the existing customer base.
And, all right, so you've made your case here, Will. Now, before, and viewers, they're convinced, they're ready to hit the buy button. Before they do, let's give them the risks at least. What should be on their radar? What's the number one worry before you hit that buy button?
Well, I think the number one issue for anybody with a company like Rivian is the pathway to consistent long-term profitability. So this is still a young company in the grand scheme of things. It's a company that is growing quickly, but it's a company that also needs a lot of investment or capital expenditure. So there are clearly big risks when it comes to companies of this kind of profile, just like there were in the early days of Tesla. As Elon talked about many times, the company had its sort of flirtations with bankruptcy. And so here, the risk with a company like Rivian is that it too has to execute, continue to raise cash and generate the sustainable path to profitability.
All right, so that's what you like. Let's also turn to one you're not such a fan of, one you would avoid. That would be Stellantis. Oh, I can see that chart. Let's look through the reasons for this. Tariff challenges.
So again, kind of the opposite way here, but given we're talking about this tariff zeitgeist, you know, this is a company that makes a lot of the vehicles are made in Canada or in Mexico. And as we know, big uncertainty at the moment in terms of how this all plays out vis-a-vis tariffs, but they're not made principally in America.
All right, bullet point number 2, another reason Will says to avoid it, declining revenue, aging product lineup.
Yeah, so this is, in many senses, not a new story. You know, revenue has been declining for quite some time. You know, the brands that the company has in its stable are brands that everybody knows, but at the same time, you know, we haven't seen that sort of new, exciting product range from a lot of the brands that we've become perhaps used to with some other manufacturers.
And a final reason you would avoid this one, Will, lagging EV strategy. Walk us through that.
So again, just I think on the wrong side of history in the grand scheme of things, that if we're talking about on the one side, you know, EV companies that are long-term aspirational, this is a company that I'm sure wants to get there, but just hasn't quite, you know, had that strategy on the EV side to put itself in a position to compete actively with the leaders in the space currently.
All right, so you're bearish, but in terms of upside risk to this call, good cash reserves, effective CEO.
So again, like the good news about some of these legacy companies is that, you know, it's a company that has a solid foundation, has good cash reserves, and this is nothing that can't be fixed over the long term. So with a CEO that's effective, that can turn the company around, with a refresh of the product offering that it has with numerous brands, there of course is a way with an EV, a credible EV strategy, that this can all be turned around, just like many big companies. But the execution's the risk.
Buy Rivian, avoid Stellantis. Will, thank you so much for your time today. Appreciate it.
Thank you, Josh.
That was great. Thank you so much for watching Goodbye. We'll be bringing you new episodes. That's at 3:30 p.m. Eastern, and we'll be right back. Let's talk about stablecoins. It's a growing corner of crypto, drawing attention from both regulators and investors. Unlike Bitcoin, with its volatile swings in either direction. Stablecoins designed to do one thing, keep their value stable. This can be achieved by being backed by reserve assets. Many are pegged one-to-one to the US dollar, acting like a digital version of cash that lives on the blockchain. Well, that's good to know on a day like today because stablecoin issuer Circle filed to take that company public with a $6.7 billion valuation. And for more, we're bringing in now Ben McMillan, Chief Investment Officer at IDX Advisors. Firm has more than $97 million in assets under management. Ben, always good to see you. So kind of it's a stablecoin moment, Ben. I got the Circle news we just discussed, have the Senate advancing legislation to regulate stablecoins. Ben, what do you make of it all?
Yeah, I mean, you kind of hit two important nails on the head. The first of which is the regulatory landscape. So if you go back to kind of the previous administration, who everybody knew was no real friend of crypto, but in particular, stablecoins really suffered. And like you said at the beginning of the segment, the stablecoins are important because this is the on-ramp for Main Street to get into crypto. A lot of people don't necessarily want the volatility of crypto, but they like the idea of making payments in Bitcoin, for example, or just generally having a store of value that's not as volatile as something like a Bitcoin. And so stablecoins is huge. I think JP Morgan actually put out a piece fairly recently that said they expect the stablecoin market to grow from roughly $2.5 billion currently to over $500 billion in the next decade. So again, I mean, this is a big deal. And one of the biggest things I think is now we have a much more clear and friendly regulatory guidance, not just for stablecoins, but crypto in general.
So Ben, it's Al Root here. Now, I think we should probably eat our broccoli. Just contrast the stable coin. What am I getting versus a Bitcoin in terms of that store of value? What's right for different people, and then maybe tie it in with how this IPO fits in.
Yeah, so stable coins are crucial because, like we were just saying at the top of the segment, they're generally backed, they're backed by, US dollar or some, definitive store of value. Now, this raises an important consideration as it relates to Circle specifically, because Circle is US based, US domiciled, and US regulated. If you look at the biggest player in the stablecoin market, that's Tether, and in recent years there's been a lot of concerns about what exactly is backing a Tether, what is in their treasury. They've had audits, there's been back and forths, and so when you look at broad swaths of Americans, including institutional players like banks, the fact that Circle, which by the way has always done a good job in my opinion of touting transparency and really opening up the books in terms of what is a USDC, that's the name of their stablecoin, what is that backed by, and in this case it's just plain Jane simple US dollars. So again, it's gives people a lot of comfort if they like the idea of potentially utilizing crypto, but they don't want the daily fluctuations of a Bitcoin or an Ethereum or something that is not backed by fiat currency. A stablecoin is a US regulated stablecoin is a great option.
So Ben, we've been talking stablecoin, but while I have you, I do also want your take on all things Bitcoin, because the move we've seen there, Ben, over the past roughly month has been impressive, and I'm curious what you chalk that up to. Is that just general risk-on backdrop? Is that investors banking on, as we've been discussing here, a more generally friendly regulatory environment? What are the reasons, Ben?
So that's interesting. We've been in the Bitcoin space for a long time, managing, accounts for investors going back to 2019. And so we've gotten an interesting perspective kind of along the way in terms of, the sentiment around Bitcoin. And this most recent move was interesting because, with Bitcoin, risk on is always part of it. But it's not like in past moves. A lot of this was kind of true decoupling. If we look at some of the biggest moves on Bitcoin on certain days, it's when we had bond market volatility. It's when we had concerns about, the US's fiscal debt situation, where Bitcoin really had the biggest moves. Coinbase actually came out and said they were seeing record amounts of buying by sovereign wealth funds, international players. This lines up with what we've seen in the gold market, frankly, where foreign central banks have been the biggest marginal buyers really since COVID. And a lot of that you can attribute directly to concerns about, the US simply printing too much money. And so we attribute a lot of this recent Bitcoin move to kind of, whale wallets you can of course see online. These are the big wallets that are, buying up Bitcoin. But again, more kind of institutional sovereign type players as a potential geopolitical store of value in a world where fiat volatility is only going to increase.
Now, Ben, you mentioned Coinbase, right? And you can go to the gold miner debate, Coinbase, Bitcoin debate as we get this Circle IPO. What would I want to say? Basically, what do you prefer? But it's more investor oriented. Who is more interested in the Circle IPO, and then who is more interested in the USDC?
Yeah, that's an excellent question, because it is the old, as you say, kind of gold versus picks and shovels approach. And even early on in kind of the life cycle of Bitcoin from an investing perspective, we saw a lot of people. We talked to a lot of clients that said, "Listen, we don't believe in Bitcoin, but we like the kind of infrastructure approach or the picks and shovels approach." And so something like Coinbase, we saw a lot of institutional demand from groups exactly like that. They didn't necessarily like the idea of the volatility of Bitcoin. In some cases, they didn't even necessarily believe in the value prop of the Bitcoin, but they liked the servicing layer. So I think we're going to see that type of demand for Circle. Now, I will say we've seen a lot more institutional demand. There's been a lot of institutional normalization for Bitcoin. BlackRock now has put it in portfolios. So I think that pie is even bigger. But Kathy Woods, I think, came out and said they'd be interested in potentially up to $150 million of the Circle IPO. So there's definitely going to be demand from kind of the infrastructure buyers of the Bitcoin ecosystem, but I think also just broader crypto investors in general.
Ben, great to see you as always. Thank you, sir.
Thank you, gentlemen.
And while we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.